now we're going to talk about U.S. exports. What does that mean going forward? And then what is happening in the international market? Because there's a lot of moving pieces right now, especially when you talk about OPEC and what's happening in Asia. So let's just touch on what's happening in the U.S. And this is where we had that big drop in U.S. Exports. That's something that we think is going to continue. They'll come a little bit higher from where they are right now, but again, still remaining fairly depressed. We did get a big increase in finished motor gasoline of 402,000 barrels a day, taking us above the 5-year by 178,000 barrels. And again, this is one that's going to be interesting because there's something to be said about what is happening right now and how does this kind of shake out when you look at gasoline, because some of it is blending. So and it's being classified as naphtha or gasoline blending, but it's really a naphtha blend. So this is what we were talking about not last week, but the week before, where there's some of that shakeup in terms of how is it classified. So that's where we're starting to see some of the disconnect. But just based on what we've seen out of Asia, there's still going to be some coming into the Atlantic Basin, but we're going to see some of that slow down out of Europe. So some of those exports will come down. The question is going to be, Europe has taken some of this product that will continue. So we're actually going to see kind of that reverse flow as the Gulf of Mexico or PADD 3 exports a bit into Europe. But we're not going to see the same type of demand out of Latin America because Latin America is taking down some of that excess coming in from the Middle East and Asia. And it's also which is just going to also displace us. So instead of going south, we're going to go across the Atlantic. Distillate was down 201,000 barrels a day. That's going to, again, remain depressed because we're not seeing Europe take in our disti. They still have, and they're actually bringing in even more that will actually reach its shores versus June, which you saw a lot of it kind of peel off and find a better home. The biggest one right now, and then propane had another had a small decline of 74,000 barrels a day, still 146,000 over the 5 years, will still remain strong. There's a bit more availability on very large propane carriers. So those rates are actually going to come down. So even though propane or LPG prices will remain elevated, you're going to see some of the rates adjust. So then that'll actually help some of the flow because where you'll pay a little bit more for the LPG, you're actually going to save money on rates, which again, will just keep some of that flow moving. Now, total crude exports were down about 1,000,001, so about 1,089,000 is what we declined, what it fell to, which turned out to be about 2.628. So we were at 3.7, which we said was that was something's wrong here. It should be lower. Then we had this big outsized move to the downside. We're again at a point where we think it's going to be at that 2.8 level as we go forward, and we'll talk about spreads because that's where we're seeing some of this pressure. Where it'll come into how we talk about Dubai and the Middle East, but you're just not seeing the pricing is just so outlandish that you'd rather take it from Dubai versus Brent versus WTI, even West Africa, which is why we continue to see some of those issues on the physical side, which we'll talk about in a minute. So West African crude flows to Asia, still remain under pressure. We're 70% of Nigeria is still available, 50% of Angola, over 35% of Congo. Again, all of these things are a net negative. And when you look at pricing, euros are trading now at 15-month lows. CPC is down to a 2-month low. ESPO, on the other hand, though, still remains strong. Still about $2.53 over dated Brent. I should say 2.90, but again, closer to 3. And that's something that is remaining, especially as we see some declines in ESPO shipments. We'll talk about that in a bit more. This is that spread. So we're just going to look at it two different ways. So here you can see just where Dubai is and the discount it is to WTI. Doesn't happen often. This is the first time really since 2018. We saw it again in 2016, obviously when there was a lot of their crude available that they were trying to work off. But this is where we've been talking about some of the disconnect. And we've been saying that there was something odd happening in the Middle East. And now that you see what the UAE has done at the OPEC meeting, and I just want to pause here for a minute. I tweeted about it. I've written about it, but I just want to highlight, some of the issues overall. So the UAE and Saudi are key members of the Gulf Cooperation Council. There's obviously Kuwait, and Qatar, but really these are the key components. Now, the UAE supported Saudi throughout Yemen. They provided personnel. They provide money. They've provided missiles, running sorties. But the Houthis proposed a specific deal, and some of the UAE proxies in the region wanted to take that deal. And now Saudi and their proxies did not, and that created some infighting. Now there weren't huge battles, but there were actually altercations or skirmishes between Saudi and the UAE proxies and actual direct personnel, not even just away from the Shia backed. So again, the Shia groups that are Iranian backed. So the UAE pulled out support of Yemen. They've said that they don't believe in it. They've still given some money, some capacity, but they just have completely or pulled back a significant amount. So now the UAE cheats and produces and exports more where they believe their right number should be as we went into November, December, creating a big problem as Saudi lambasted them for doing so. So that became a rift because Saudi, UAE is like, all right, well, you give us all this nonsense, we make up for it, but yet you say nothing about Iraq, Russia, Nigeria. And now when you look at Iraq is, even though they're producing at 3.9, they're not exporting. They're exporting at about 3.2. They're at a multi-month low because they're just not seeing, I think it's 7-month low in total. I talked about it on Friday because they're not seeing that demand out of Asia. And again, that's leaving some of these excess cargoes, which are pricing themselves at a steeper and steeper discount. So then the UAE launched the Murban futures, which are physically settled and they have no destination clause, which means they can travel anywhere in the world. And it's just, I should say, they can travel anywhere in the world and get resold. So with a destination clause, if CNOC buys it, it's going to a CNOC port. It's going into one of their tanks. If there's without a destination clause, Exxon can buy it and sell it to Shell, who can then sell it to BP, who can then sell it to Statoil, who can then sell it to CNOC. It can go anywhere, and that's when you see all these ships always moving and adjusting. So now the UAE is currently exporting 150,000 above their target and want their baseline move from 3.1 million to 3.8. Now, if you look at what UAE has normally produced, it's much closer to 3.1 than 3.8. So why do they want the adjustment? Well, they've made investments that have increased their capacity and have increased their ability to produce, export. They've invested throughout there. And if you think about a company, when you invest in your infrastructure, you want to start earning money on the infrastructure because you've just laid out billions of dollars. You now want to cover some of that debt that you've taken out and start to earn some of that cash, which is where this strife comes in. What we've been saying is that there's going to, kind of a meet in the middle where Saudi will say, okay, well, let's go to 3.4. We'll let you go to 3.4. We'll pull back a bit, but you will to let you up, but it won't be, you'll have to meet us halfway. And we'll talk about some of those numbers in a minute. But this is why it wasn't just the fact that WTI was getting more expensive, because don't get me wrong, it was, but there was also Dubai there was more volume. So you saw pricing decreasing in that region, or at least staying flat, because Iraq had more to sell, the UAE had more to sell. And now all of a sudden you had WTI Brent, West Africa moving up, and all of this getting cheaper. And now it's starting to make a bit more sense that there was just those excess cargoes. So now looking at it in terms of Brent, so Brent is more expensive then Dubai by $4.29, reaching a peak of about $4.35, which is really the highs that we've seen in 2018 and 2019. Again, just saying that I would much rather, if I'm a buyer of crude, I would buy from the Dubai or Dubai flagged or pegged oil versus Brent versus WTI, which again is creating some of those issues, which is going to keep our exports depressed. So then when you look at gasoline exports, you can see that there's, coming back now to the U.S. product side, you can see that we had this spike, but when you look back in 2018, we had a similar spike. So we're still not at the highs that we saw. Like it's still a lower high, but again, we saw some of that increase. We expect to see some of this come down, but still remain elevated because we do have some more slated to go into Europe. So it'll pull back a bit, but still remain well above the 5-year average and kind of in this, but just still within the top of the cloud. Now, when we look at distillate, we were expecting this to come sideways a bit. Instead, it actually fell to a seasonally adjusted low. That's, again, Latin America remains weak. Europe remains weak in terms of their demand. So this will recover just because, again, there's that timing delay, but it'll just recover and still remain well within the bottom of that cloud. Now, when we talk about U.S. exports or crude exports, we're expecting it to stay kind of at this level of about 2.8 million over the next few weeks, just because, again, we're having some of that pressure. Our exports just really aren't there, and that's going to keep some of that crude trapped in the U.S. But it's still, again, on a 4-week rolling average, we're still elevated. So this is where we're going to continue to see this pull back and come closer to, let's call it 3.2 on that rolling 4-week average as the average is pulled down based on the shift of exports and just pulling in a bit more imports. Propane exports, again, still remaining elevated. It'll still stay at the top of the cloud, still remain well above the 5-year average. This is something that is going to be strong when we look at just where the demand cycles are in general. So when we look at OPEC and we look at some of the numbers, so when we look at where compliance is, so Angola is at 186% compliance, but remember, they can't sell crude. So they're unable to sell their current offering. So obviously they've cut some of their product because they've had deferrals and they just don't have buyers. They're at 186% compliance and they still can't sell their oil for August. So remember, looking forward, they're struggling to sell August, which is a problem in its own right. Nigeria is at 126% compliance. Again, not because they want to be, but because they can't sell oil. They're struggling to sell. Could they sell it? Sure. But at what discount? And are they willing to take that discount? And so far, the answer has been no. They'd rather preserve some of it and keep it within and behind a wall. But then when you look at the UAE, so the UAE is saying that they're producing at 2.67, but they're exporting at 2.9. So this is where that disconnect comes in between what are they actually producing and what are they exporting, because they could easily be pulling down from storage and then just refilling storage over time. But they want their baseline based off of 3.8, not 3.1, allowing them to increase some of their throughput, as Libya is producing at about 1.16, and they're going to export about 1 million barrels, which we'll talk about in a minute. So then when we look at non-OPEC, you can see that just a mixture of who is in compliance. Russia, obviously, just barely out of compliance, as they have been. And then when you look at total compliance of 110%, again, it's really being driven based on Saudi Arabia is still, they're bringing back their extra cuts and coming back with what has been allotted. So they're winning or I shouldn't say winning, but they're bringing back on both sides. So that compliance will fall, while West Africa compliance is really being driven based on slowing demand and a little less on them trying to be good citizens within OPEC. So then when we look at ARA had an increase of about 1.7 million. You can see it's coming back to that 7-year average or so. We typically get builds this point in time. here you can see that the draws typically start. Instead, we just expect to get closer to kind of that average just based on what we're seeing. Some slowdowns, just some uncertainties with the Delta variant, going to keep things cautious within Europe. Starting to see some slowdowns on exports, imports, just based on German data, with them missing estimates on industrial production, which we'll talk about in the Econ show. But again, this is just going to keep some of this crude trapped in some of these regions. So now when we look at loading schedules, so you can see loading schedules continue to get updated. When we look at Libya is actually now, this is a little dated. July, Libya is going to be just over 1 million. You can see, obviously, Angola has kicked some into August. Same with Nigeria, you've had some slippage. And when we look at Russia's, they typically are the last to sell. So there's usually some increases that will happen over the next few, I would say the next 10 days, that will just take this closer to 4 million. Now, when we look at the Med, that's pretty stable. Then when you look at, obviously the UK has come back after the pipeline work, and Congo remains fairly stable. So then when we look at future pricing, because Nigeria trimmed their offerings as Angola is struggling, and the Mediterranean, the medium sweet continues to get moved lower. So the pace of sale of Angolan and Nigerian cargoes for August is slower than normal, as deep backwardation and a wide Brent-Dubai spread have deterred buying interest from Asia. So then when we look at some of the OSPs in general, so more than half of 38 Angolan cargoes and nearly 70% of Nigeria cargoes for August loadings have yet to find buyers, even though they're still fairly low versus historics. Brent Dubai EFS was at the $4.38, now closer to $4.29. Now, Republic of Congo, which is typically China's a big buyer, traded at a discount of $1.90 to $2 to dated Brent, which is a 50-cent discount to last month. Again, kind of seeing that walk back. Gunvor sold 100,000 tons of Urals for July 18th to 22nd loading to Glencore at dated Brent minus $3.65. It's the lowest price since mid-April 2020. Again, seeing that rollback. So then Latasco sold 100,000 tons of Urals for July 17th to 21st loadings at a discount of $3.45. CPC has been offered at $2 at a discount of $2.30 and $2.15. That continues to again move lower as those have been offered. Still no bids, which means that they're going to have to come down to find those bids again. A total of 28 cargoes of Russian ESPO, totaling 2.84 million tons, are scheduled to ship from the port of Kazmino in August, according to the preliminary data, which equates to 672,000 barrels a day from 695. So that's where you're seeing some of that steadiness in terms of spreads. And then when we look at SOCAR, sold 90,000 tons of CPC blend for July 23rd to 27th at dated Brent minus 225, which was the lowest price since May. So again, this is where we continue to see a lot of these problems. And again, this is for the end of July, loadings. And this is where we continue to see some of these pressures when we're talking about, because remember, July, you get bought in July, you're purchase now, load end of July, takes 6 to 8 weeks to get to your location, another 8 weeks, 8 weeks to 14 weeks before you're cracked into product. So you can see on how this is really looking into further and further into the end of the year. So now when we turn to products, total in Fujairah, total stocks fell by 1.888 million, declining 8.2%, which comes after last week's build of 437,000 barrels, which draws across the board. So light distillates, including gasoline and naphtha, fell 791,000 barrels, a draw of 10.9%, which is after last week's big build of 1.833 million. Now, remember the draw, some of the disconnect is from the disruptions into refiners. Those are now back in operation. We expect to see some of those light distillates start to build back up, especially as we see some of that softness going into Asia. Now, middle distillates, including diesel and jet fuel, fell 287,000 barrels, which is the second week of draws. Supply of gas oil was seen tighter in the Middle East as those regional refiners maintain limited production on that lackluster demand. And they do obviously use this for heat, for cooling when you look at power gen. So we expect to see some builds, but again, that will remain fairly flattish in general, while stocks of heavy resid fell 810,000 barrels. In the bunker market, Fujairah was starting to see some slowdown. So we expect to see light distillate fairly flattish, but some builds starting to come into mid and heavy disty. So now when we talk about crude oil on water, as we've been talking about, this is really accelerated, coming back to that 5-year average, which is what we've been talking about, where even though guys are talking their production numbers, we're just seeing more and more of it hit the water, which is relating into more crude in transit as well as more crude going into storage, as we'll see over the coming few weeks. So then when we look at oil in transit, you can see that we've had that strong rally back to the 5-year average. This is what we've been calling for. Here it is. And just based on what we're seeing in transit and what's being moved around, we expect to see a little bit of an increase on that movement throughout the next few weeks. And it's going to result in more crude in floating storage. So you go from crude oil in the water, so there's more in transit. And as it continues to go into transit and you start to see some of the headwinds and hiccups and the supply chain issues, it's just going to result in a bit more sitting on the sidelines waiting to unload. And here you can see we had a small increase of floating storage. We're now back above where we were in 2016, obviously still below where we were in 2020, but you're starting to see kind of this creep up. And it's not that we're going to get this explosion back up, but again, we just assume it to go sideways over the next few weeks. So then when we look at what's happened in Europe, so Europe had a draw across the board, more specifically in fuel oil, as we did get some recracking. But again, there were some nice draws across all products. And now this is going to start to flip a bit. Not to say that we're going to get these massive builds, but this is where we keep talking about this sideways move, because European imports of refined products from the Middle East, mostly of middle distillates, are expected to see a nice rebound in July. 23 tankers hauling about 1.5 million tons are expected to arrive in Europe from the Middle East in July. Includes 10 ships en route as 644,000 tons, and another 13 tankers that have already arrived with 851,000. In addition, 3 tankers have been booked. So we're seeing that flow already. So we saw some of it come through, and now there's going to be more behind it, which again, given some of the slowdowns that we're seeing, and not massive slowdowns, just some of those pauses on that reopening and pauses of activity, is going to result in some of those additional builds. So here, when we look at gasoline, you can see that gasoline had that bounce. We saw a little bit of an excess, moving into the system, and it's still over the 15-year average, but again, still, moving within that typical seasonal line. So we just assume that now, when we look at some of the data sets, that it's really just going to be kind of that sideways move over the next few weeks. Fuel oil, had that really big bills. Now we're starting to see that come back down to normal. Here's something similar. We expect this to go sideways from here. Now, I'm sorry, not sideways, but it should come down a bit as this gets turned into other product. So it'll result in a bit more gas oil, a bit more gasoline, and a little less fuel oil at this point. Then when we look at Singapore, as we were saying in general, it's just going to be this sideways move. We had a fairly big draw coming from prior, as we had that increase, and now coming back to the lows or the bottom of that range, which we expect to increase as we have talked about, starting to see some of those exports come from Southeast Asian nations. Residual fuel had a draw, same with middle distillate. Light distillate actually had a fairly big build. When we look at resid, we expect resid to stay fairly depressed, or should see those declines hold. Middle distillate is the one that we're going to get closer to that 13 million, still remain fairly in line. And then light distillate on the gasoline side is the one where we see the most pressure, just given where demand is around the world. So this just puts it into perspective. We're still above the low point we hit in May for middle distillate. This is something where it typically sees a little bit of a build. So we think it's going to track closer to the seasonal, but still remain at this, let's just say 2021 low, but just remaining fairly consistent. While light disty is breaking back out to the highs that we saw from April. We expect to see some drawdown, but again, that sideways move, which will be counter-seasonal, because typically we're much lower on the light distillate side. But here we just think that we're going to stay fairly elevated and just go on a sideways pattern as there's the mix between what is being sold, what is being exported, and what demand looks like within Asia. So when we look at time spreads for Brent, you can see that time spreads have pulled back a bit, still remaining elevated. And again, just putting pressure on what people are buying and how people are buying product as they avoid some of the expensive crudes, which we've seen so far hold within WTI. You can see WTI still remaining strong while Brent has pulled back a bit. But again, this is going to pivot people away from the U.S., which is just going to keep that pressure on exports. Then when you look at refining capacity in terms of margin, you can see moving further negative, which is why we continue to see some of that excess, just really not seeing that demand as run rates get crimped coming out of Asia. And then when we look at Singapore hydrocracking refinery margins, seasonally adjusted low going over the last 5 years. And just back to the lows for 2021, as again, there's really no profit just given where demand is and where the export market is. Urals coming under a little bit of pressure just because when you look at just how you're getting some of that bifurcation, which is why Urals keep trading at a steeper and steeper discount, trying to keep their position in some of these refiners, which when you look at it on a Mediterranean level, you can see that they're actually firmly negative, even with some of the discounts. Again, just putting some pressure on where these margins are and where refiners are going to run, softening some of that oil demand in general. Crude imports into China supertankers starting to increase a bit. We expect it to continue to creep higher. Still not getting back to some of those normal levels, just because we saw a little bit of a cut in SOEs and as well as some of those cuts in teapots, which we can see here, where when we look at Shandong independents, they were down about 2% from about 75 to about 73%. And then when you look at state-run, we're actually coming down to about the 5-year average in some of these key regions, because we're not seeing the same type of exports as we've been talking about coming out of China, but we're also seeing we're not seeing the same type of demand. So even though they're not exporting as much crude, they're also not importing as much oil, which again is becoming the kind of this issue, because that oil has to go somewhere, or it will go somewhere, and we're going to start to see that show up in some of the other storage points. And here's where we start looking at Asia storage starting to creep back up. You can see on a seasonal level, they typically come back down. It's not that we're going to go up or down much. We just think we continue to go sideways as the crude shows up, and it just doesn't, it sits on the water waiting to unload. Then when we look at North Sea continuing to creep up, and remember the comps are getting a little bit easier, so this is something that we continue to think is going to get closer to and eventually really hit that 5-year average. West Africa, again, as we keep talking about the pressures within West Africa, this is going to send storage back up unless we start to see some of these discounts get increased to incentivize buying. The Middle East, as we were saying, outside of obviously 2016 and 2017, it still remains elevated and is creeping higher, speaking to some of the softness in Iraqi sales as well as UAE, elevated numbers, which is something that we're going to see. Saudi increased pricing going into some of the markets. Some of them are elevated versus historics. Some of them are right in line with historics. It's just going to be a matter of what are they trying to incentivize. And even though they've increased pricing into Asia, we're seeing term buyers continue to show up. It's just how long will that last as some of the floating market and some of the futures provide some discounts versus what Saudi is offering. European storage fairly flat. This is something that we think is going to continue to creep higher. We did get some decent builds into storage, again, coming from offshore to onshore. Then that means that we should get a little bit of build offshore, some draws onshore, and then vice versa. And then when we turn to China, once again, Shandong crude stocks seasonally adjusted, all-time high, continuing to remain the case. And then the same with fuel oil, still remaining elevated. But fuel oil imports last month into China's Shandong province from Malaysia rose to the highest level since November. According to Kepler, shipments rose to about 514,000 tons in June, up from 434 tons. And that's where we think there's, again, they were trying to get the last piece before that short cycle oil and semi-refined goods levies increased, which I think is what they were trying to get in front of. So I know we covered a lot. There's a lot of moving pieces in terms of what makes up the energy markets, especially when we look at oil versus product versus other. So if you have any questions, please let us know. We like the back and forth and being able to go over some of the intricacies that we continue to see and where we got some of the spikes in demand, some of the declines going forward, and how that will all shake out over the coming months. So thanks again for watching. If you have any questions, again, you can find me on Twitter. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.